You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Education Wednesday. Yes, it is time once again for the premier options educational program. Time for Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting network upon which so many of you are binging. August, yet another record month for you folks out there. We love you all. If you're one of our many on-demand listeners, all we ask that, hey, keep rating and reviewing, keep liking what you see and hear out there so that new folks can continue to discover the content and drive up my bandwidth bills even more. And, of course, if you want to go above and beyond, we just got off. That's why my voice sounds tired already, listening. We just got off an awesome pro Q&A session. No rest for the wicked, no rest for me, diving right into another great episode of Options Bootcamp. If you want to check out that pro Q&A, man, we dove deep, I say, into the world of volatility, the term structure, all sorts of good stuff going on in there. You want to check out Options Oddities every Friday. You want to get entered into the drawing for our awesome Pro Trading Crate giveaway. Just gave away another one a week ago. You know where to go, theoptionsinsider.com/pro. It's the only way to get access to all that cool stuff. And trust me, it is pretty cool, even if my voice is tired from bringing it to you all the time. Hey, we were off earlier this week, so I got to rest my voice up. So we're fired up and raring to go. Theoptionsinsider.com/pro is the place for you to go to learn more. Or if you're really cool, don't tell anybody. I'm just telling this is just for you. /secret club. Turn down the speaker so no one else heard that but you. And then check that out. I think you're going to like it. Maybe you're going to like my co-host, too. I don't know. Seems like you've liked him for 200-plus episodes now. He is the black-headed one himself. Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir. How you feeling after the big 200, sir?
Oh, man, it's good. You know, I ordered a cake for the occasion and stuff. I didn't invite you, but sorry. Maybe for the 400th show.
Yeah, I noticed also when I showed up at the live event that the Manny's had strategically already been ordered and eaten. So I see how it goes. I see how you roll there. By the way, sir, 200 of Options Bootcamp. I see you, and I raise you 500 coming up this Friday on VolViews. How crazy is that?
Whoa. Okay. Yeah. How about that?
Serious business. Over a decade of that show as well now. So, yes. The milestones coming fast and furious. I can't even keep track of them all, sir. So many shows firing off. So many have such great pedigrees. We love them all. That's going to be another big party this Friday, listeners. Noon Central, 1 p.m. Eastern. So if you want to join us live, we will make it open and available to all comers out there. You can check out the live. In fact, that's what I mentioned. That's what I neglected to mention, I should say, about the Pro. It also gives you access to the live. On Friday, we open the doors up to everybody so you can come play VolViews 500. Speaking of coming and playing, just like our 5-star reviewer this week, it looks like this is from iTunes. This is AJ Gentner. He says, 5 stars. Best Options Pod. Well, thank you, AJ. He says, I started listening to their shows from the very beginning and have learned so much! Exclamation point. Thank you. Double exclamation point. Well, back at you. Triple exclamation point, AJ. We appreciate the love. Mr. Dan, I know you love yourself a little bit of love. We have to say to AJ and everybody else who takes the time to rate us and review us out there, sir.
Man, AJ, that is super awesome, man. So appreciated. Just speaking for myself, but I bet I speak for Mark too. That's why we do this stuff, man. And I just love hearing that. I eat it up. It's what keeps me going.
And what keeps the show going is the next segment. It is time for some options drills.
Colin Boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
So festive here on the show every week. Let's get into some options drills. And Mr. Dan, a little birdie told me recently, you've been doing some deep dives into the world of credit spreads. We touched on them a few times on the show recently, actually, including our infamously titled How Not to F Up Your Credit Spreads. Don't listen to that one with the kids around. NSFW there because of Mr. Dan. I think he had a few beverages before that show. But Mr. Dan, in all your deep dives into credit spreads recently, it seems like you've been doing a little bit of learning, a little bit of the old learnings going on. What have you discovered? What have you uncovered during your deep dives into the world of credit spreads that you really wanted to share with our listeners today, sir?
Well, it is true, my friend. It is true. I may have mentioned this on a past show. I kind of forget, but I have developed a brand new system. Really, it's a complete system that starts out with a proprietary scanner that I had literally built just for me by the Chicago Board Options Exchange. And it is called Credit Spread Genius. And man alive, it is gosh darn fantastic. I love it. And I was talking to Mark. Mark said, hey, what do you want to talk about on the show? And I said, you know what? I have got this new credit spread trading system, with a scanner involved, and I would love to share it with our listeners. And Mark thought it was a great idea. And that's what I would like to talk about a fair amount today, just sort of how it works and why it works, and just some takeaways that can make you a better credit spread trader in general.
All right, sir, let's dive into it. The floor is yours. I know you're giddy. Dan isn't usually giddy. Quite frankly, he's usually a little drunk by the time we get to showtime here. This week, he is drunk and giddy. So what do you got in store for us, sir?
Hey, it is afternoon. I told you, if
That's
you
true.
want me to be sober, it's got to be before noon.
I remember down the SIBO, you were always at Ceres by like 9 a.m. So, yes, this is a little late in the day for you.
Oh, goodness gracious. So let me tell you a little bit about the background of this. So over the last, where do I even start this story, right? I got to leave room for the prequel franchises. So over the last few years, I've been trying to simplify my own trading by really systematizing it, right? And not just my own trading, but hey, man, my role in life is to help all traders become better traders as well. And so I thought, what if I could create this system that not only I could trade to find the highest probability credit spreads in the universe, but also our student traders here.
Sounds like you just found one, sir. Did you find one?
I literally did. It was a call credit spread in Meta.
Our listeners love when your trades ding in the background. It excites them.
Now, to be fair, I'm not trading right now. I just have Credit Spread Genius up, and one just popped up live real time. So, I started thinking about it, and like John and I teach a very simple system for analyzing credit spreads, and even for managing them, which I'll share in just a minute. And, that's what I would typically use myself. And that's what our student traders also use. But, like the hard part, one of the hardest parts about any trading is just finding that initial idea. I mean, I know there's some folks out there who like only trade spiders, only trade apples, only trade Tesla, but that's not a lot of people, So what I would find myself doing quite often is just going through stock after stock, looking for something to trade, and if you're just looking for credit spreads, you pass them up. So I would just kind of like look for stuff to trade. So I thought, well, how can I start out with like a short list? How can I start out with some candidates that are just by some other measurement arbitrarily good, and then take a look at them and do my own proprietary market taker, analysis. So you heard me talk about Options Radar here on this program many, many times before. And that was built by the Chicago Board Options Exchange to find short squeeze trades. And so I thought, hey, there's an idea. What if I just have the CBOE send me like big institutional size trades that some professional trader, aka the smart money, is trading in big size? Because, if somebody's trading in big size, it means they have a strong penchant. They believe in it. And hey, man, if you're a professional trader, your career is riding on it, right? Like you lose $500,000 one day and you might get fired. So I thought, yeah, that's what I'll do. I'll just go back to my friends at the CBOE and say, hey, build me one for credit spreads. And you know what they said?
They said, come back when you're not drunk. That's what they said.
Exactly. Or at least come back with some beers. But they said it can't be done. And I was like, well, why not? It seems pretty straightforward. They're like, well, our programming technology is only for single leg options. And I was like, oh man, like the most technologically advanced exchange in the world, and they don't, they can't just wave a magic wand and make this happen. Oh man, come on. So what happened is I talked to him and I was like, can we find a way to do this? And there's some really smart folks over there. So they did. And so what this starts with is it pops up whenever there is a credit spread that some big institutional smart money trader is making. It just shows up on the screen and makes that little noise you just heard a couple minutes ago. And what the benefit of that is a couple of things. One is I'm not going through 5,000 different stocks to try and find a decent spread. It saves me hours and hours of time. And B, like it's that extra check before me even looking at the trade. It's like, hey, here's what somebody who's, probably really, really smart is trading, whose livelihood depends on them making money on it, and whose job depends on them not losing money on it. So let's just look at those and piggyback off those. But Mark, as well as I do,
the size money is not the smart money, sir. Not always, at least. Not always.
Yeah, not always, right? Like, how many traders on the trading floor, Mark, do you remember who you're like, how did this guy make it to work today? Right?
Most of them.
Yeah, there's a lot. So I'm not a fan of like just a pure alert service where it's just like, hey, here's some trade that popped up that meets some criteria. Go trade it and cross your fingers. I'm not a fan of that at all. But taking these trades and saying, okay, here's a short list that probably mostly ought to be good. Now let's do our own analysis. Does that make sense?
It does, sir. I'm in. Let's go. Actually, as you were talking, I was trying to catch up to you. So I did a little drinking of my own. So now I'm ready to go. Let's dance.
Good. I'm glad we're on the same page. So basically the way it works is when something pops up on Credit Spread Genius, what happens is we get the alert, and right now, Mark and I are recording this Wednesday, September 7th. It's 1:15 Central Time. So we've got another couple hours before the market closes. I've got 4 trades sitting here. And so what I do then is I go and say, okay, I'm not just going to, blindly believe that these are good. I'm going to go look at them. And so what we do is we look for 3 main things and maybe a couple other things. So there was let's see, what is this one that just popped up in Meta? I want to take a look at it. So let's see. If it meets our criteria, I'll start the conversation with that one. September 22nd. Well, I mean, it kind of does, actually. It kind of does. Yeah. Okay, so I'll start with that one. So somebody traded 328 Meta, formerly Facebook, right? Meta, September 22nd. So that's the regular September expiration that happens in, what is it, two weeks? Should be 2 weeks, I think, right? Let's take a look here. That's next Friday, the 16th. Okay. So it's got like a week and a half till expiration. They sold 328 of the Meta September 22nd, 177.5 call credit spreads at 82 cents. Now, I'll tell you what, not only have I found some good trades from Credit Spread Genius, but I've also learned a lot. Like you have heard both me and Mark preach that once you stop learning, you're done for, right? Like I don't want to blindly speak for Mark, but I think you'll agree. And if you don't, hey, jump in.
Don't you put words in my mouth. I have never said such a thing. Hogwash.
Right. But I'm still learning, right? If I stop, I mean, why would you listen to me if I'm not still trying to further improve my craft, right? The market changes, traders have to change. So, yeah, they sold this at 82 cents. So where's my calculator? I got a brand new desk here. I forget where I put stuff. I got drawers here. Oh, my goodness. So 328 contracts times 0.82, times 100. If they held this all the way till expiration and Meta doesn't go above 170, they make almost 27 grand. So, potentially nice little trade here. But I got to look at it first, right? So I look at it and I say, okay, criterion number 1 is if it's a call credit spread, I need to see resistance on the chart. I need to see some reason why the stock might not rise above that strike price. And it's not just because one of the biggest mistakes people make with credit spreads is they say, oh, they're high probability trades, so I'll just trade a bunch of them because most of them win. Okay, most of that statement is true. They are high probability. Most of them should win. But you also have an adverse risk reward that counterbalances that. So if all you do is rely on, it's high probability, you might win $1, lose $5, and you'll tread water forever. Another mistake people make is they say, well, there's positive theta, so there's an inherent advantage. It's not true either, because what balances that is gamma. And if it moves, too much, you run into trouble. And again, back to that disproportionate loss. So we have to find these other reasons. And again, the first criterion is resistance. Now, I look at this and I see that there is indeed resistance. First of all, at the 50-day moving average, which is at 166.5 basically. And then there's also the 20-day moving average, which is 167.74. And then I took the simple, I took the 200-day moving average off there, so I got to put it back on there. Hold on one second. 200. Oops, that's not 2,000. And my 200-day moving average always has to be red, so let's get that red up there. Oh, the 200-day moving average is way above it. That's okay. So we've got strong resistance at the 50-day moving average, but then we also have simple horizontal resistance also at 170. We saw it got down. It was support back on April 27th, and then since then it's become resistance, and it tested it on June 15th, June 24th, 25th, and 26th. Tested it on July 7th. Like, it's tested it several times. Went through it a couple times, but always pulled right back. So from a technical standpoint, that resistance is helping us more than the option pricing model says it will. Does that make sense, Mark?
It does indeed. So folks who are listening right now, if you had to summarize the key elements you're looking for in a credit spread, maybe we break it down to like 5 points, 5 talking points. What would you say are those key 5 elements that you're looking for when you're lining up a credit spread? Because I know our audience, I know our listeners, I see the results of the various polls and engagement and the questions they ask them. And there's, let's say, 1 or 2 premium sellers out there, Dan. So they may be intrigued by this. So what would you say would your top 5 points or areas of focus be when you're looking to sell a credit spread, sir?
Yeah. So one is I need support or resistance. If it's put credit spread support, if it's called credit spread like this, resistance. The second thing is I want to make sure that earnings doesn't fall before expiration of the spread in question. I want to have earnings out already or like way far in the future.
So you don't want to mess with earnings. That's a key point. A lot of people like to trade with earnings. You want no part of that noise, sir.
That's right. I've got a different earnings trading system that uses time spreads that works great. I don't know. I've never met anybody who's made a credit spread earning system work consistently because there's just too much uncertainty. So no earnings. The third thing is I want to see a volatility edge. And this is not the biggest deal. I would say support or resistance is the biggest deal, but it is a big deal. Because if I'm going to make a trade, I would like it to have a statistical advantage. All like position trading, which is what this is, what we do as retail traders, position trading. All position trading has an element, a big element of randomness to it. A lot of them have a directional bias. Credit spreads kind of have a directional bias. And, that's just I've never met anybody who can successfully predict direction in the long run. So I need an extra edge above and beyond any technical skills that I may or may not have. So what I do is I first look at the volatility chart, and I mostly key off historical volatility. And then I go, and in fact, in Meta, the historical volatility is 40%. So if I go to the regular September options that expire in 9 days, for those who are watching this live, I can sell a 45.5 volatility in those calls. So I'm basically selling volatility more than 5 point. Yeah, I can sell a 45.5 volatility. So about 5.5 points higher than where historical is. Now, I also go back and I look at the volatility, the implied volatility chart, because I want to see right now is a lower high from where it's been in the past 6 months. And, it's slightly in the bottom half, but Meta has had some pretty much more profound volatility, in the more distant past. Not to mention some of those volatility surges either related to earnings or, related to earnings, basically. So from a implied today compared to implied in the past 6 months, I mean, it's not bad, but it is above today's historical. The actual option I can sell is above today's historical. So that gives me some indication that, the implied volatility is somewhat overvalued, which means if I sell this spread, and this is like a very important key here. So let me just say it nice and slow and clear. That means if I sell this spread, I'm selling it for more than it's worth, more than it should be worth. It's overpriced, and therefore I get an advantage. If you have any business and you are always able to buy below what its value is and sell above what its value is, you will make money. Now, there's some business like manufacturing where you have to take into account all the value added and electricity costs and all that business. But if you can always buy below the cost, the value, and sell above that, you'll make money. That's how all business works, and that's how option trading works, but just on a much simpler, faster scale.
What about Beanie Babies? I heard good things about Beanie Babies these days. Can I buy low, sell high in the old babies, sir?
Yeah, you might be able to. John Kamisic, who works with us, I think he used to have a Beanie Baby collection.
He was a Beanie Baby scalper.
Yeah, I think he was.
Did you just highlight another trade while we were talking, sir? You picking up another one? They slinging more meta.
Yeah, and what's interesting there is there was a 300 lot 150.55 put credit spread that expires on this Friday, just popped up. Very interesting. It may or may not be the same trader trading this. Different sizes. One was 328, one was 300. But that almost lines up for a nice little iron condor in there, which, boy, for the past month, since the beginning since last expiration, I guess I should say, since August 19th, we've been in a pretty swell little range perfectly between those two strikes. So, yeah, it's very interesting. Not only getting the trade ideas and trading them and seeing, a lot of them, most of them are trades that I would trade, but not all of them. And sometimes I'm like, why is this person making this? And sometimes if I think about it long enough, I arrive at that answer. And that's become just really interesting. Just a really, really interesting activity.
And we got to get rolling to our listeners. But really quickly, I'm just curious for you, as you've been crunching all these numbers, looking at all these trades, would you say the majority of them are call credit spreads? Are they on the put side? Which way are they leaning?
Yeah, so that's interesting too. Today, we now have 5, 2 of which are meta, but we've got 1, 2, 3 call credit spreads and 2 put credit spreads. So, today it's fairly balanced, but a couple of weeks ago, when the market was going down, we saw a ton of call credit spreads. So it kind of tipped me off direction wise as to what a lot of the so-called smart money was doing.
All right. Good stuff here, sir. Let's keep on rolling. Let's get to some of your good stuff, listeners. A little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Hope you enjoyed that deep dive into credit spreads. Actually, Dan, before we get into this week's question, let's pay off. We had an interesting, somewhat contentious question on the show last week. Remember, we were debating, it was submitted by a listener, that article in the Wall Street Journal about the magical impacts of options on the market over the past couple of months, in particular options expiration, acting as these catalyst points, and then also serving as an accelerator to the pretty aggressive rally that we saw throughout most of the summer months until the last couple of weeks. But we were kind of, I think the fair to put it, lukewarm on the concept of options really being this massive driver. Expiration, separate deal, a very pivotal event. It can be, at least. but ascribing these other powers to it and the options, I tend to get a little bit leery when I see those types of things. But we put it out to our audience, Dan. We said, hey, the journal claims that the options market was a primary driver for the market rally and the VIX decline over the summer. We made it very simple. We said, do you agree? Yes, no, or what is gamma? Because obviously they were talking about gamma, Dan. And, it came out very early on that most of our audience did not agree. As the poll went on, some people came in who obviously had read the article. Maybe they liked it because it ended up being 60%. So still a clear majority saying no, but 40% saying yes. I think thankfully for us, Dan, means we've done our job well. No one shows what is gamma. So that is good. But interesting. I was surprised that only 60% said no. Are you surprised, sir?
I was kind of surprised by that. And funny story, I ended up talking to that guy, Eric, the reporter, because I sent him a LinkedIn request and I was like, hey, I want to talk to you about this article. And, I just shared a couple of thoughts. I don't like being too contentious. Well, every once in a while I do. Who am I kidding? But I chose not to be too contentious and chatted with him. And he's a pretty smart dude. But, I still disagree with his stance, the point of the article.
They should just have the title be "Options Are Magical Things," and they could do whatever powers you ascribe to them. Interesting stuff. Well, we'll keep an eye on that stuff. Our audience maybe a little bit more willing to go along with that than us, Dan, which is kind of interesting. Also, last week we asked you folks, the markets were rocked by Powell last week and are still down to start the week. Does this second leg of the inflation sell-off have legs, or will the bulls return with a vengeance? Quite simply, where will the S close at the end of Q3? So at the end of this month, listeners. At the time we posted this, it was next month. And we gave you 4 choices: higher, so north of 4,300, around the level where we posted it. We were still north of 4,000 when we posted this question, listeners. It was 4,000 to 42.99. Lower, so 3,700 to 39.99, where we're hanging out right now, or much lower, below 3,700. And Dan, 41.2% chose the lower range, so kind of where we're hanging out now, 3,700, 39.99. And then we had second place was 4,000 to 42.99. Then we had a literal tie, 18.6% each for the wings, north of 4,300 and below 3,700. What are your thoughts, sir? That surprised you?
Well, we've got some smart listeners, as you know, Mark. So the fact that you put this out here, when did you put this poll out there again exactly?
This was last Monday.
So last Monday, and here we are 9 days later, and they freaking nailed it. We got to be proud of our listeners here. And so I'm not surprised by their answer, because I imagine I would have answered about the same way. It's always hard to say what you would have done without reconstructing the past. Of course, I would have had the right answer, but I'm not surprised by the market activity, so I'm definitely not surprised by their answers.
Let's get out to this week's question, getting more along the lines of kind of what you were talking about, Dan, your different indicators that you use those in your credit spread system, but there are many different indicators you can use for many different reasons. This week, we're asking you, there are many different indicators that traders use to signal red flags in the market. Which red flag indicator is the most important to you? Gave you 3 choices and then the infamous other. We have inverted yield curve, backward VIX curve, the death cross pattern, or other. We already have a write-in for ViewOp with volume profiles, which is an interesting one as well. Dan, which of these is your favorite quote-unquote red flag indicator? Or do you perhaps have a write-in of your own, sir? And then B, what do you think our audience is voting for?
It depends how we define red flag, but I would say that if we're trying to predict recession, which, unfortunately, somehow or another, there's not a definition of recession anymore. There used to be, and
apparently we have to wait until the government says it, because otherwise the technical definition doesn't apply. The two quarters, nobody cares about that anymore, even though we already had that.
Yeah. So I don't know. You can't have subjectivity in these definitions, but by the old school definition was, I guess, the real definition. And by the way, it doesn't matter what the definition is, because it doesn't matter if you're technically in a recession. I mean, it's just a word, right? So, I mean, I would say we are in a recession by the definition, and the inverted yield curve did precede that, which it does really, really often. So if we're talking red flags as in, hey, we're going into a recession, boy, the yield curve has a pretty good history of predicting that. I know the death cross pattern also typically has some legs to it, some follow through. You would think I'd have a better answer for the VIX because I watch it all the time, but I'm not sure. I know for sure that I can think of a good handful of times when we've had backwardation in the VIX curve and, the world didn't end. So I guess my favorite would be the inverted yield curve for that red flag, the red flag of recession coming.
All right, let's see what our audience is up to. And our audience, 34.5% saying yes, they agree with you, the inverted yield curve. 31% for the backward VIX curve. So interesting. Our audience, a little bit of a savvier bunch. I thought that would be a popular one. The old death cross, 24.1%. I think half of that vote, Dan, is because it just sounds cool, right?
Yes.
It's the best sounding technical indicator. Validity or not, I'll leave that up to you. And then 10.3% saying other, with a nice vote here for the volume weighted average price with volume profiles. You guys have a vote? What you think is the biggest or your most useful red flag indicator? Get on over there to @options. Make your voice heard. Let's go out some questions here, listeners. First to Canute, maybe a Viking writing into us, Dan. He says, so if the notion of covered calls and short puts being risk equivalent is only from the same strike, can't we really just throw away the notion that covered calls and short puts are the same thing? After all, people normally sell out of the money calls and puts. They rarely sell deep in the money puts or calls. People keep going back to this, Dan, this notion. We discussed it a few weeks ago, and then we talked about it again. We had a question about it again, I believe, on our live mastermind show where we talked about it again. People, this notion, they have a hard time wrapping their heads around the risk equivalency, what we're talking about there with covered calls and short puts is from an analysis from the same strike. And this Canute person is saying, is that meaningful at this point? Because who does that? Who sells deep in the money calls or puts? So Dan, what do you think about that the same strike analysis maybe limits some of its utility?
Well, yes and no. I mean, it's a good point to talk about, but they're two different conversations. I mean, one thing is that it's really important to understand synthetic relationships, especially that one, that when you use the same strike, a cash secured puts and a covered call are the same thing. And you get value out of knowing that, and therefore us talking about that and not throwing away that notion, as Canute says, by if I like a covered call position in a particular stock, but I don't own the stock, but maybe I want to own the stock, I might sell an in the money covered call. I've done that. No. I might sell an in the money cash secured put. I've done that a number of times. It doesn't really make sense to do the covered call. I mean, you pay a couple extra commissions, and sometimes maybe it does make sense to do the covered call. But if I can put on effectively the same position in a much simpler way, paying less in commission and getting all the exact same benefits, then yeah, I mean, I'm going to do that. And you need to know about that. And it would be a disservice for us to throw away that notion. But yeah, I mean, you're also right. In practice, we typically trade the out of the monies. And so we trade them as different positions. I mean, in much the same way that I would trade, like if I was looking at Meta, I would trade a 165 put that's in the money by $5, different than I would trade a 155 put that's out of the money by $5. One I would put on because I probably want to get assigned, but I want to get assigned and keep the time premium. and therefore get assigned at a lower price than I could just buy the stock right now. The other one, I probably don't want to get assigned, and I just want to skate and keep that premium. So, there's a lot to talk about here. And that's like, this is legit exactly why we need to understand these synthetic relationships, because each strike, whether we're talking calls or puts, sort of has its own characteristic, whether it's above or below the money.
All right, let's get out of here on this one, Dan. From Shin, it goes perfectly what we were just talking about, spent the first half of the episode talking about, which is all the various indicators and things that go into analyzing credit spreads. And also just now with our favorite red flag indicator, Shin wants to know, what is your favorite technical indicator? And do you feel that one or two are more useful for options traders than others? Dan and you and I have discussed this on the show in the past. The whole subject of technical analysis. You're more of a technical guy than I am. So what do you have to say for Shin here? We can get him back. There we go. Dan, did you hear any of that question at all?
Yeah, I just gave like the most brilliant answer to any question I ever
It was amazing. Amazing. And the technology god said, no one will ever hear that, sir. All right. So for Shin, before the tech gods lack their smiling upon you again, he wants to know, what is your favorite technical indicator, and do you feel that one or two are more useful for options traders than others?
Well, I would say by far the most useful technical indicator is good old-fashioned, simple, horizontal support and resistance. It is the least sexy, most boring, nothing fancy, but it is by far the most useful, and that's why we use it as kind of the cornerstone for our analysis of credit spreads.
There we go, listeners. It's not sexy, but it gets the job done. I used to say that all the time. I said it again, I think, when we discussed this on the live mastermind. At the end of the day, the only technical indicators I saw a lot of meaningful value out of, or really any meaningful value, were the ones of the most widely held, the most widely followed, because guess what? Everyone's doing that. So sometimes if you get really into the weeds with a very, very nuanced, very subtle indicator that a lot of people don't use or follow, I don't know, you may find utility. I'm not here to slam all technical analysis. If it works for you, hey, have at it. But I've often found a high correlation between the size of the audience using it, which means it's usually the more low-hanging fruit stuff, and the actual utility of the indicator. All right, great questions, everybody. Dan, a fun episode today. We dove deep into credit spreads. We talked a lot about technicals today and different indicators. If folks have questions about any of that stuff, they want to learn more, where should they go? What should they do?
I'll tell you what. I usually just give you our address and say, sign up for a free account or whatever. But if anyone was interested, found my thing about credit spreads interesting, and our service, Credit Spread Genius, we actually, for a very short time, we're going to have the replay up, which is simply at markettaker.com/view. VIEW. So market, like stock market, taker, like take what is rightfully yours, 2 T's in a row, markettaker.com/view. And you can see a replay of the video that explains it. And we make a really sweet deal at the end of it too, for those of you who want to buy into it.
There you go, markettaker.com. If you guys have questions about that, maybe you have your own top 5 tips or techniques or indicators that you use to find credit spreads or premium harvesting opportunities, you want to share them with us, maybe with the rest of your listeners, hey, we'll keep it quiet just to all the audience of this show. But if you have ideas, you have other questions about that stuff, you know where to find us. We are, of course, at Options on most major social media platforms. Questions at theoptionsinsider.com also works. If you get in there on the live, you get bumped to the top of the list for all of your questions and your queries and your comments. Of course, you get to join us for the pro exclusive stuff as well. So if you have your own methodology that you find works for you for finding credit spreads, hit us up, let us know. We want to hear about it. It's fun to debate and discuss these topics. Selling premium is a very subjective thing sometimes, and people have different ways of going about it, so we like to hear your thoughts on this as well. That's going to do it for us today here on Options Bootcamp. Don't worry, Brian's coming at you live to tape in a little bit here. So if you want to hear OPR, check it out on the on-demand side, wherever you get the rest of our content on demand. We'll get them back on a live huddle soon. Don't you worry, listeners. Then back again tomorrow for our double dose of goodness, which is, of course, Option Block at noon, and then Twifo after that at 1:30 p.m. Then on Friday, the big partay, the 500th episode, spectacular of Volatility Views. Join us. It's going to be a good time, live and open for all. Should be good stuff there. And then Options Oddities coming up after that. Then back again next week, all the way through to another Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.